All right, what's up guys? Hope you're doing well. James here from jamesdforsythe.com. So going over the recent financial stability report from the Federal Reserve Board. This is obviously the November one. The last one was in May. But as I was going through it, I started to notice some like liquidity problems and stuff in the metrics that they kind of show for the Treasury market, right? Which is kind of a big deal, especially considering the fact that, the U.S. Treasuries are supposed to be, or I guess they are, the most deep and liquid market in the world, and they kind of underpin the entire monetary system. So it's kind of important of what they're doing and whether or not you can actually get them. So basically, and I'll be going through a few charts. All of those will be posted in the community tab of my channel in general. And obviously I'll put the names and cite everything. You can also, I'll put the PDF version or a link to the actual report itself. Well, I don't remember if the link may or may not be a PDF form, but regardless, it'll be in the description with everything else, so you guys can find all the charts and that sort of thing too, and see what I'm seeing, right? And so yields on Treasury securities have been increasing since May. I mean, the Fed's been hiking rates. Anyone who's been paying attention kind of has noticed that. And right now they are near or above their median levels over the past quarter century. And so basically this can be seen in one of the charts I give. Basically, nominal Treasury yields have increased to levels that haven't been seen since before 2008, right? Right now, looking at the 2 and 10 year, one, you can see where it's inverted in the graph itself. Two, it's also like they're above 4%. And again, you haven't seen these types of rates since before 2008, right? Since then, they've basically been around. The 10 years been around bouncing between 3 and maybe 1.5 until it just goes below 1 in the past couple of years. But regardless, so there's that you can see, and you can also look. This also is reflected in nominal Treasury term premiums. And so term premiums are a measure of the compensation investors require to hold longer term Treasury securities rather than the shorter ones. So it's a premium that you pay for the term of the Treasury. That's why they're called term premiums. And basically it's that whole, you're paying for, or it's the increased premium the investor requires in order to basically compensate them for that longer duration of the bond, right? And you can see that this was little changed and low relative to its long run history, right? And you can see this in figure 1.2 in the report itself, to where it actually shows to where it's barely above zero in that respect. And whereas in around 2000 era-ish, it was at least above 1%, right? And to where it actually in the past looks like 2018, 2020-ish, somewhere in there, that sort of time period, it was actually below 1%, or I'm sorry, it was negative to the tune of almost 1%, right? And so also, specifically with respect to liquidity itself, liquidity metrics such as market depth suggest that Treasury market liquidity has remained below historic norms, right? And this can be seen in figure 1.4, which will also be in the community tab just because I think it's that important, right? And so what is market depth? Market depth basically kind of shows or reflects the quantity of an asset available to buy or sell at the posted bid and ask prices. Basically, it's kind of shows liquidity a bit, but basically like how much there is. So like the actual quantity of, in this case, Treasury yields or Treasury bonds that can basically be pushed out into the market, right? And can fulfill those bid and ask prices, right? We get into later, not in this video, but in a future one, kind of the different, or why bid and ask spreads are kind of important and how that kind of reflects liquidity in a way, right? But you can see this with respect to, in terms of the actual market depth. And as of right now, well, October 2022, let's see, the 30 year is roughly, I'll say around 12 million, right, in total market depth, whereas you see the 5 and 10 years are both kind of around 50 million, right? So kind of showing a difference in scale of the duration for one, and just how much, like in terms of the actual quantity and depth, is kind of weighted for those, I guess it's medium term sort of bonds. or at least treasuries. And then I'd assume it gets much larger as you approach the shorter end of the curve, because they're used for more. Those are used kind of specifically for liquidity purposes, rather than, maybe like an actual investment type of thing, right? And so that's one of the things that you see. And I kind of wanted to leave this here, right, and have a shorter video for once, kind of posting those things out. And I will put, again, the actual charts themselves will be posted in the community tab as it'll go, right? But anyways, yeah, I'm going to leave this one here. So I hope you guys have a good night, and I will see you on the next one.